Global reserves just hit the lowest level since 1992, and somehow nobody's freaking out about it. There's no breaking news, no sweaty guy on CNBC, no market panic, just silence, which is weird. But there's a reason why. While everyone's busy arguing about whether AI is coming for their job or whether Elon Musk is even human, the global financial system has been quietly rewiring itself. Most people have no idea what's happening. But before we jump into why this matters, you need to understand why being the global reserve currency is America's secret weapon. On the surface, reserve currency sounds boring, like something only Wall Street bankers care about. But in reality, it's the invisible engine behind the entire US economy. Here's why. Being the reserve currency means every other country needs your money to do business. Want to buy oil, settle trade, pay international debts? You need dollars. So countries are forced to buy US bonds and hold dollars in their reserves, which means America gets access to the cheapest capital on Earth. The US saves more than $200 billion annually just from this arrangement. It's the greatest financial cheat code in human history. Nobody voted for it. Nobody signed anything. It just fell into place after World War II, when most of Europe and Asia was rebuilding. The US was the only major economy still standing, so the dollar became the default. But 70+ years later, people still assume this is permanent, like gravity, like taxes, like Marvel making another Spider-Man movie, but it's not. For the first time since World War II, alternative options are finally emerging, and the data tells the story. In 2000, the dollar made up 71% of global reserves, clear favorite, no contest. By 2010, it had slipped to 66%, still dominant, but something was moving. Today, it's below 58%, and every major crisis has pushed this trend further along. After 2008, there was a short-term flight to safety to the US dollar, but the long-term effects were different. Following the financial crisis and the Fed's quantitative easing, central banks started asking a question they'd never asked before. Are we too concentrated in dollar-denominated assets? Then in 2014, the US imposed sanctions on Russia. And now countries were asking another question. What happens if Washington decides we can't use dollars either? This kicked off the Russia-China partnership. For the first time, there was a serious push toward building alternatives to the dollar, and more importantly, alternatives to the entire US financial infrastructure. Systems like CPES started to emerge. Systems built from the ground up with one goal: root around US dependence. Then came 2022. The US and its allies did something that rewrote the unwritten rules of global finance. They froze roughly $300 billion in Russian sovereign assets. They cut Russia off from SWIFT, which is essentially the WhatsApp for global banking. It's the messaging network that runs basically all international banking. Whether that was the right call or not is a video for another day. The point is, it sent a signal to every central bank on Earth. Your financial system can be switched off at any moment if you go against Washington. Now, central banks were looking at their dollar holdings and thinking, maybe we need backup plans. For decades, if you were a central bank trying to settle a trade between Brazil and China, two countries with no connection to the United States, you had one option: route it through New York, through dollar correspondent banking, through US regulated infrastructure. Every trade, every payment, every settlement touched the American financial system, not because anyone preferred it, just because there was nothing else. There were no other liquid markets for these transactions, so both central banks held accounts at a correspondent bank in New York like JP Morgan or Citi, and they facilitated the transaction. This arrangement turned the US financial system into the foundation of the entire global financial system. And with that came massive unfair advantages. Advantages economists call exorbitant privilege. 3 pillars. First, intelligence. When a trade between Brazil and China clears through New York, it doesn't just move money, it moves data. It gives the US visibility into who's buying, who's shipping what. A bird's-eye view over global trade. Second, investment. Every country needs dollars to trade. Countries can't store cash under a mattress. Treasury bonds had constant demand. It forced the world to buy US debt and let America borrow money at significantly lower interest rates than other nations. Third, jurisdiction. Because trades ran through New York, the United States could act as the supreme regulator. like in 2022 when the US froze $300 billion in Russian assets. So this whole system the United States built wasn't about empowering global trade, it was about power, building infrastructure that allowed for global control, and other countries finally had enough. But you can't replace these things overnight. It takes coordinated multi-country effort, and that's exactly what's happening right now. It starts with BRICS, a group of emerging market economies that came together to cooperate on economic, political, and financial issues. The idea is simple. Individually, these countries can't easily challenge the dominance of the United States, but together they can. Most people still think of BRICS as just Brazil, Russia, India, China, and South Africa. But it expanded in 2024. Now it includes Saudi Arabia, the United Arab Emirates, Iran, Egypt, and others. Over 11 member countries that represent more than a quarter of the global economy and nearly half of the world's population. They're not just doing business together, they're actively creating infrastructure to operate outside of the old rules. And this brings us to the single most underreported financial story of 2026, the unit. If you've never heard of the unit, you're not alone. Most people haven't, because traditional financial media only covers what gets clicks. Nvidia's earnings, Trump's latest tweet, Palantir's newest product. But the unit is the stuff that actually matters. It's a blockchain-based settlement tool designed for BRICS countries. It lets member countries bypass the US dollar by using a neutral unit of account instead. One backed 40% by physical gold and 60% by a mix of BRICS currencies. In plain English, it's designed to replace the role of the US dollar. In January 2026, it moved from concept to operational pilot. Right now, it's trying to do one specific thing: give the world a neutral measuring stick for pricing commodities. This is crucial because one of the dollar's deepest, least visible forms of power isn't just that commodities like oil get paid for in dollars. They get priced in dollars. The dollar is the reference point. As long as every commodity on Earth is quoted in it, the dollar is baked into every global price. The unit is a direct attack on this system. It's intended to break the US dollar's monopoly on price discovery. But the unit itself won't replace the dollar. There has to be infrastructure behind it. That's what mBridge is. Another thing traditional financial media probably hasn't covered. It's a blockchain-based cross-border payment platform that went live in 2024. The pipe's intended to let countries trade directly with each other, meaning no correspondent banks, no JP Morgan, no Citi, no New York watching over global transactions. Which brings us to the main point. For the first time since World War II, we are seeing real alternatives to the US financial system begin to appear. The entire basis of the dollar's dominance is starting to disappear. The correspondent banking system, the data advantages, the regulatory choke points. It all disappears if transactions start being settled through these new systems. The multi-decade-long systematic advantage the United States had, it disappears. And we're seeing other signals of countries shifting away from the dollar. Since 2022, central banks have been buying gold at the fastest pace in modern history. In early 2023, Brazil and China signed an agreement to settle bilateral trade in yuan and reals. In late 2023, India completed its first-ever purchase of UAE crude oil using Indian rupees instead of the US dollar. For the last 50 years, Saudi Arabia and the United States have operated under the petrodollar system, where oil is priced and traded in USD. But now Saudi Arabia is openly discussing accepting Chinese yuan for its oil sales. The point is, none of these things individually can replace the dollar. Not BRICS, not mBridge, not bilateral trade deals, not gold buying. But that's not what's happening. That's not the point. What's happening is something much harder to spot, much harder to pinpoint. It's optionality, and optionality kills monopolies. Because the truth about the dollar's dominance that nobody talks about is this: nobody chose the dollar because they loved it. They chose it because there were no other options. For the first time in over 80 years, other options are starting to exist.